Everybody, I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure: I added some longs today Friday. SPIR, NBIS, TTD, NVIDIA, Meta, TQQQ, Soxel, AVGO, Google are all new positions. Is today? Did we go down enough today for us to consider this to be a market crash? It certainly felt like it at lows. We closed down like 2.7% in the SPYs, 3.75% in the Qs, 2.5% in the IWM. Yeah, well, I don't know what's it? Seven is the first. I don't remember the rules on. It's five. And is it per the index or is it based off the SPYs? 7% SPX. That's the number that I kind of remember. Been a while. Been a while since taking a series exam where I had to know those exact numbers. TLT up 1% today. Little bit of a fair trade there, I guess. Almost seems like we're going into like liquidate everything at this point kind of thought process. Yeah, so let's dive in and have a look at these market technicals. Oh man, I feel like I've been trading so well recently, and I jumped the gun today. I kind of let my read through on the technicals override a little bit my thought process on the market dynamics, and it definitely hurt me. Because I feel like the market dynamic information is telling me that we are going to be getting a really big, sharp, hard bounce at some point soon, but not in the early stages of this week. I feel like starting at like the midpoint of the week, maybe as early as tomorrow, just because of the amount of downside extension we have. I feel like the amount of downside extension we have might fast forward a little bit when a bigger bounce actually begins. But the dynamic information, I feel like, is telling us at the earliest, like Wednesday, Thursday, or even higher probabilities to get into early next week. But the degree of downside extension from the technicals is telling me it could be sooner than that. And with the large gap down this morning that had us at extreme extension but still above yesterday's low, I said to myself, like, I don't want to miss the sharp bounce. So I wasn't as patient on those longs as I had been on all of the other occasions that have been super successful for us. Pretty consistently we have been waiting for well beyond our traditional extreme oversold metrics to come in and buy, and it's paid us very consistently to do that. I mean, like it's been really impressive actually, just how well we have called out every short-term bottom on the way down. Again, we called it out on the 25th at the low. We called it out at the 28th, basically at the low. We called it out on the 4th, basically at the low. We called it out on Friday, basically at the low. And, for me, every single day, by taking these shorter-term longs, it's paid really well. And now, coming into today, my head process is like, all right, soon we're going to be getting that sharper, like bear market bounce, for lack of a better term, because I know that we're not technically in a bear market, and it'll be really sharp and face ripping. And again, all the data I really think points to it not happening quite yet. But I got that in my head combined with the gap down to above a tail low in extreme extension, which is actually a chart setup that I really like for longs, to jump in early. And it certainly hurt me. I did not repeat the game plan that I was repeating these last couple weeks of being so patient till we're like $14 to $19 extended and then starting to build in those longs. I started doing it more at like the opening price area today, which is like 567 ish, I guess, for these SPYs, where we had $12 of downside extension, not the 14 plus that I had been buying, but $12 of downside extension above yesterday's tail. Again, that tends to be a good buy, especially as the 8 and 21 EMA is beginning to spread a little bit. And not only was I too early, but today's low was the most extreme extension that we've seen on any point of this overall market sell-off that we've been going through. I mean, at lows today, we hit like some of the most extreme downside extension I've almost ever seen, outside of maybe the COVID sell-off specifically. The degree of downside extension that we saw today rivaled anything that we saw in the 2022 bear market on the downside. We were really there. SPY's low today is 555 spot 60. ADMA is at 578, a little above 578 right now. So basically $23 of downside extension in the SPYs. Holy crap. And then the Qs, I went at it with the same thought process as what I just described. It was too early. Definitely was feeling it. At lows today, we got down to below 469, 468 spot 66. ADMA is up at 494 and change. What's that? $26 of downside extension? Is my math right on that? Insane. Like I said, this rivaled just about any degree of downside extension that we saw in the entirety of the 2022 bear market. Really, really crazy. The selling was relentless. This market has gotten so fearful at this point about the data pointing to a looming recession that's being created by tariffs and everything else that's going on. And it seems like only now, finally, are a lot of market participants actually waking up to it. But that sentiment's starting to hit a point where I was definitely too early. It definitely cost me today. It cost me six figures today. But I still really think that this bigger term bounce is actually going to happen with this market, and it's going to be hard and fast when it occurs. And again, that might lead to a further shorting opportunity, but I'm actually looking for a move to beyond the ADMA on a bounce back, and I've got fairly high confidence that it's going to happen. It's just a matter of just how early I am on the trade is really my concern. Not if, but when. So we'll see how that plays out. I see the Qs here had the highest volume day. At lows today, it did feel like we got some degree of downside capitulation, but for the most part, up until, or with the exception of this little like 20-25 minute period here near lows, this was a very orderly sell-off. Even with the amount of downside extension we had, the sell-off was very orderly. And look, we know CTAs are still selling, and that's probably flat tape data, $39 billion worth of stock this week. And the flip side of that is they are quickly approaching levels where they're running out of stock to sell. It'll be curious to see just how much, if we can get that data, just how much it's estimated that they sold today. Because, the data shows that really on Friday, historically, is when inflows begin to occur this coming Friday. And once these CTAs sell the expected $39 billion worth of SPX this week, that they are also running out of stock to sell. So it's not honestly extreme as we were at highs. In reverse, at highs, like I keep saying, everybody was in the pool. Positioning was overwhelmingly long. There was almost no one left to buy. The data as of Friday's close actually shows that for the most part we got back to just moderate positioning in this sell-off. That we're not at like that October 2020, is that 3 or 4? 23, right? Yeah, October 2023 low, where just every piece of data, like this October 2023 low, was the opposite of the February 25th high, February 2025 high, in terms of positioning. Where down here it was like there is no one left to sell, and we know in this November there's going to be a lot of buying that comes in. This high was we know that there's no one left to buy, and the data shows that there's about to be a bunch of selling that comes in. Where we've gotten back to now is nowhere close still to where we were in October 2023. There is definitely room for participants still to sell, but we're washed enough and extended enough as we go into a period where historical inflows begin to come in that it makes sense for us to see, I think, a sharp bounce relatively soon. That's what I'm positioning myself for. Granted, definitely started a little bit too early on that and too early on that today. And, my P&L is showing the result of the mistake of starting too early. And it just is what it is. And I can't be too upset because besides today, I feel like the entirety of this down move I've traded extremely, extremely well. And overall, my P&L shows it. But today definitely hurt by starting too early. So, yeah, I think that kind of covers everything that I've got on the macro from Bill K here. The slow grind of the S&P down and VIX up makes it hard for long option holders to make money. If you have SPY puts, they're only paying from the underlying move and not from vol expanding or from the speed of the move. Yeah, it makes it harder to monetize long options the way that this move is happening. Yeah, it would be nice to see some sort of bigger picture downside capitulation on this market. I also feel like we don't have to have that happen though. Sometimes it's just like the robots just turn. Like there's a chance that we just gap up tomorrow, and then the robots just turn, and then you start to get the grind up instead of the grind down. I'm sure it'll still be like today. I mean, today was still a huge range, even though it actually felt orderly under the surface. So, we'll see. I think any big gap down is still viable tomorrow. We'll assess if we get a gap down, and if so, where it is. Any gap up tomorrow is going to be tricky because we're going to be in one of those situations where it's like, do you really want to chase a gap up to 565 in the SPYs when we were at 555 yesterday? But also, we're only at 565 with the ADMA at 576 or something like that. We've got $11 of extension with a $4 gap up. A big gap up tomorrow is going to make it really tricky. So, Pat was really the VIP champion today insofar as his patience on saying, we're too early. I really want to just wait to see some sort of like downside extension to be able to come in and buy, and was super patient to really, it seemed like based on the information he was providing us, only start buying into this accelerated down move here. And I don't know how much you kept Pat or if you're even listening, but like, bravo, great job. And if you're keeping some of that overnight, I'm pretty sure you are. Certainly hope you are. You're putting yourself in like a phenomenal risk reward. Basically, all of it. I love it. You're putting yourself in like a phenomenal risk reward spot here, and you were so patient on that entry. You got such good pricing that like that's what you really want to have. Like Pat really did it right. Where then if we get the gap up to 565 tomorrow, and everyone who is flat looks at it and they're like, oh man, what do I do here? We're $10 off of yesterday's low, but we're $11 off the ADMA on the daily. It'll be difficult to do anything new. And Pat will just be in a golden spot of, hey, how much profit do I want to book here versus how greedy do I want to be to look for a further bounce when everyone else is potentially missing the move. With that said, I think any gap down tomorrow. I mean, I was really surprised to see that short-term tactical, given Friday's bounce, still closed in that green zone. We're obviously like probably at lows like off the Richter scale on the green zone, and even with this $6 bounce into the close, still going to be deep in the green zone. And as we know, it's pretty rare to get like a day. I guess tomorrow would only be a day 3. I don't remember what Thursday was. I guess Thursday was in the 2. So now I think we've had 3 tomorrow morning we'll probably have three short-term tacticals in the green in a row. It's very, very rare to see four. So I do think that any gap down tomorrow is very viable. A gap up tomorrow, if you've got longs on, will be an opportunity to book a little bit, but I would still look for more. If you're flat and we gap up tomorrow, then you're just going to honestly be in a tough spot. So the ideal situation was to do what Pat did. Great job, Pat. Or, not as good of a job, but I'm just at the point where I don't sell into this degree of extension. I just don't do it. I don't know what else to say. You could say I don't. It means I don't manage risk well, or maybe it even means the opposite. But uh, it has made and saved me so much money over the years to not liquidate positions into this degree of downside extension. Obviously, you need to understand your account size and your exposure level, because a market that's extended can always become more extended. That's the definition of momentum. And if your sizing is too big, you could blow up your entire account. But for me, as a rule, I'm not like, even though I started too early and I was down a lot of money, especially at lows today, I'm not selling into that low. In fact, reaching out to the risk team at T3 to see if I can get my lockout bumped so that I can add at that degree of extension of the downside, and it's exactly what I did. I doubled my lockout today, and then I still at a certain point at lows was locked out of a double lockout. So it shows you how much I was down at a certain point today. But I don't sell into that degree of extension. So either you are the VIP like Pat and you're super patient and you really bought the right spot and I really hope it pays for them, or you started too early like me, you're enduring some pain, but I'm still confident that these new trades that I put on, I mean, some of them I closed in the money on Meta. I closed like flat small green on NVIDIA. I definitely closed down on TQQQ, down on SOXL, but not dramatically. I'm pretty confident that I'm still going to make money on those trades. I just need to make sure I manage them properly. I think that basically covers everything that I've got. Today was an absolute bloodbath for the market. One of the worst sell-offs I almost ever remember seeing into this degree of extension already. I don't think that degree of selling can last. So that's all I got. I'm happy to answer any questions anybody may have. Scrolling up here, the first one was from Pete with a screenshot here. I'm not really sure what I'm looking at on the screenshot. Let me read what you say for context. On equilibrium, you mentioned the other day, you look at the width between the 8 and 21 EMA. Could you run through that again? Sure. I don't have a science behind, like, at the index level, what constitutes a very wide spread between the 8 and 21 EMA. It's definitely more art than science. When you get really fast moves to the downside or the upside, by nature of how moving averages work, the spread between those moving averages increase, especially when you get accelerating downside, because the 8 EMA is giving you an average based off the last 8 days. So 1, 2, 3, 4, 5, 6, 7, 8. So just using my chart that I'm currently sharing, the 8 EMA is giving us data through the 27th, whereas the 21 EMA is still calculating in data from the consolidation in the beginning of February. I'm not going to bother to count back 21 days. So as you're accelerating down like that, it just increases the distance between the 8 and 21 EMA. And if you remember how I use the 8 and 21 EMA, the space between the 8 and 21 EMA is what I consider to be the equilibrium zone for the market. So I don't know, if you go back to February 28th, where the market was already breaking down at that point, the 8 EMA was at 596.50, the 21 EMA was at, let's just call it 600. So you had a $3.50 spread between those moving averages. And we were able to actually bounce back to almost a 21 EMA, kind of the midpoint between the 8 and 21 EMA on that next trading session. What did I just say that spread was on that day? $3.50. Now, if you look at today, We got the 8 EMA at 578 versus the 21 EMA at 589. So we went from having like a $3.50 spread basically to an $11 spread. So basically the equilibrium zone is widening, and I find that when that zone widens, and this is more just generally speaking, I don't have a rule on $11 spread between the 8 and 21 EMA versus a $20 spread between the 8 and 21 EMA. But generally speaking, as that spread widens, that equilibrium zone gets bigger. There's a higher probability that when a bounce comes, that it's not just a bounce just to the 8 EMA, just to the lower band of equilibrium, that the bounce actually exceeds the 8 EMA and maybe gets to like Tate likes to use a 13 EMA as well on his chart just to give him the midpoint between the two. I don't use a 13 EMA myself. I don't like having too many lines on my charts, but I can just eyeball it. If 578, 589, so I don't know, somewhere like 584 or so, we would be at like the midpoint of the equilibrium area. So that's pretty much it. It's like we tend to always want to measure our extension versus the lower band, but you have to keep in mind that like we're like the extension versus the upper band is also like further increasing because it's not moving down as fast as the ADMA is, if that makes sense. So it's just an extra piece of information to pay attention to when you're measuring what a bounce back might look like. On your chart that you sent, I hope you don't look at charts that tight. It doesn't look like you do. It looks like you cut off part of it, because you really want to make sure that you're getting more context in there on a daily chart than just whatever that is, 6 candles or so. I, generally speaking, always look at my daily chart as a starting point going back 90 days. And then I can increase or decrease a little bit by scrolling in and out to get, a finer picture or a wider picture. But, I would never look at a daily chart like this. I can't get any information off the chart that I have up right now as it is. From Tate, is this pullback making you reconsider SPY QQQ $10 to $11 extension where we start to look for counter trend trades? I'm going to say no. I'm going to say no on that because it's always in a normal market environment just been like a general rule to kind of help us measure things, and for the most part, it's worked great. We had periods of time. We know that market sell-offs tend to happen faster as a general rule than when markets go up. We had times back in 2022 where we got $20 plus extended with the indexes also, and it just shows you that we are extremely extreme basically at that point. So I just still like it as just like a broad general rule of market measurement to use that. You definitely could make the argument, and that argument would make a lot of sense, that us getting to whatever I just said, $22 of extension in the SPYs today is different than when we got to like similar levels in early 2022, because the index was a $420 index and it's a $460 index now. I keep that in the back of my head. These are not ever hard, fast rules. These are always more just, wow, look how extended we're getting, but let's think about it in the context of everything else. And that's why up until today, and even today when I started really buying, we were $12 extended from the ADMA on the daily chart. But up until today in this sell-off, the context around the sell-off was telling me $10, $11 isn't enough. It's notable, and it means I probably don't want to be pressing short when we're there. Like the spot to press short in this down move has been starting at $5 of extension. But the context of the sell-off has been telling me that I want to be patient to wait for like extremely extreme extension in order to come in. And you want to be paying attention to all the layers of probability that we look at, like the gamma environment that we're in. If we were in a positive gamma environment and we got $10 extended, that's a lot. I mean, depending on how positive the gamma is, but if you were like $5 billion plus of positive gamma, and all of a sudden we're looking at a $10, $11 extension, that would be something that you really, really want to buy or short sell. Whereas in a negative gamma environment where we know everybody and their mother is forced to sell, 10, 11 is not going to be enough. And we've been looking at, 14 to 18, 19 to really come in on the other side where we've been having a lot of success doing that. So I appreciate the question, Tate. I think it was a very good one. From John S. I've heard you mention you don't like to put limit orders too far away from the inside bid and ask. That's not true. That's generally not true. Maybe you misheard me, or maybe I said something accidentally. I'm wondering if you could explain your reasoning for that. Also, how far would you say is too far away from the market to place a limit order on TQQQ, for example? No, so I do that. I put orders out every single morning that I feel like are so far away from where the market's trading that they are a very, very low probability of getting filled, and I usually put them out anyway. And guess what? Every once in a while, especially on a day like today, they do, and I'm glad that I'm glad that I have that order out. So, and sometimes what I do is I will, wherever my last limit order is, I put an alert out to let myself know, wow, your last limit order that you had out for today just got filled, and you need to be prepared for that from a game planning perspective, whether that means putting out more or whatever. So I definitely do it. It's just, if you're putting out orders super, super far away from the inside market, most of the time they're not going to get filled, and it's a little bit of a waste of energy. And I do keep in mind in the back of my head that I don't want to have too many canceled orders. Not that I've ever had any problem with this, but I've seen compliance have to reach out to traders in the past for too many canceled orders versus filled orders, because it can look like you're doing some sort of spoofing or market manipulation where you don't actually want to get filled. So they pay attention to like your rate of canceled orders in the compliance department versus filled orders. It's extremely rare for that to come up as a compliance issue. I mean, I don't know what the percentage is, but if you're putting out like 90+% of your orders that never get filled on a day-to-day basis, then you could run into some compliance issues with that. So, I keep that in the back of my head as well, that I really want to be putting out orders into the market that actually have a chance of getting filled. But otherwise, I have no problem at all putting bids or offers far away from the inside market, and I do it all the time. From John Bulger, do you think there are margin calls at that low today? So I don't know enough about how margin calls actually work in terms of, I know that Rock always talks about 10 and 2 as the time of day in which margin calls actually occur. And I've noticed that we see on those margin call days sometimes some real down ticks at those times. But I don't know enough on how it works. I've never traded a margin account. I've never had a margin call. I just don't know if every single broker is required to have their margin calls occur for the same times. Like I just genuinely don't know how that works. I don't think that margin calls are necessarily like a constant rolling thing throughout the day. I could be wrong on that, and it would be good to know if anyone has more information than I do. But the 10 a.m. and 2 p.m. information that Rock always seems to mention does seem like things at a minimum are aggregating around that time for potential margin call selling. So do I think that there was margin call selling very specifically at 310 today? No, I don't. But there's a degree of a money manager out there who could be saying to himself, oh my God, I know that if the SPY breaks 559, then I'm going to have a margin call at 10 a.m. tomorrow, and that person's risk manager is requiring him to immediately lighten up, knowing in advance that that call is going to occur, as just an example. So I don't know why in particular all of a sudden at 250 when we finally started to get some sort of downside acceleration. I don't think it necessarily had to do with margin calls. I just think it was some degree of capitulation, but this is not what real capitulation looks like either. Like I still remember I wish I saved or had the 5-minute chart from this day here on February 25th for Amazon. I wonder if my 15-minute chart can go back that far. February, no, I think I just missed it. Um, 28th. Yeah, I don't have it anymore by a few days. But that's what this day, if anyone remembers, because we bought it, that's what capitulation looks like. Massive volume, puking stock. Someone is just screwed and down ticking a massive, massive, massive order because they can't take the pain anymore. I have seen that happen at market wide levels before, and I've seen that happen at market wide levels where it has marked absolute major bottoms for the market in the exact same way that that was a major short term low for Amazon. I've seen it happen at the market level. I would also say though that for whatever reason with how the modern market changes, the modern market trades, I should say, that like real capitulation puking bottom that we saw on Amazon used to occur at a market wide level. I would almost say more times than not at major lows in the earlier stages of my career. And now I would say it actually rarely happens. You rarely see that these days. It still happens once in a while, and it certainly did on Amazon that day. But you kind of rarely see that massive like final degree of puke sounding that comes in. And maybe that's just because market participants got smarter and they realize that that's not in the exact same way that I was saying like I don't sell or stop out at $20 plus of extension in the spies and Qs. I just don't do it. I'm just gonna sit here and endure the pain and endure unlimited risk. I'm not recommending that other people do that. I'm telling you what I do. So people don't seem to puke out that way. It's more like, like we were chatting before about how the robots could just change tomorrow. It's more like today they're forced to sell. They're forced to sell. A lot of it's mechanical. They're forced to sell, and then we kind of just hit a point where that switches, and ideally that happens like it did on the Russian invasion of Ukraine day that I always like to reference. Ideally, that happens with at least a big gap down, or maybe you're not getting intraday downside capitulation, but you're getting like a really big gap down. Market participants recognize that it's a gift, and then immediately the thing is just getting bought up. But other times, it's like I won't be surprised if this is an absolute short-term bottom for the market at all. But I would also not consider this to be major capitulation. Maybe you could characterize it as minor capitulation, but this doesn't look anything what that Amazon sell at that low looked like on that day. Thanks for the question, John. From Austin, what are the odds that the extension bounce trade fails even with $20 plus extension? I don't really know how to answer that question. At that degree of downside extension, I'll start by saying it becomes very difficult. I want to say like almost impossible, not impossible, but almost impossible because there's no such thing as impossible in trading. You hit a degree, and we were getting there at lows with the daily chart where the rate of selling this way, it can't continue for too much longer. It could continue for another day or two, but it can't continue for too much longer. We can't sell. I mean, we sold down intraday today $14, and that was after a how big of a gap? 576. So that was a $15 gap, and then whatever I just said. And then it was an additional $14. We can't trade down $30 a day every single day for a very long time. Happened today, could happen tomorrow, could even happen the day after that. But I would say that every day that occurs, it's a lower probability of it happening again. And every day that it occurs, there is a higher probability of getting a more major oversold bounce to occur. Um, so it's very, very difficult for the market to maintain that degree of extension on the daily chart at the index level. If you want a really bad scenario, I think a really bad scenario here would be if we went sideways for the rest of the week. That would be a trash scenario. If we just bear flag down here and just went sideways for the rest of the week, that would be a time correction. We don't have to get a price correction. We don't have to price correct up to 580. It is possible, even though it's not what I'm looking for, and I think I would still be okay in a sideways market here. It is possible for us to just go sideways for the entirety of the rest of the week. I mean, think about it. We had a $30 range today. Stay stuck between, or $20 range or something. Stay stuck between the 575 of yesterday's close and the 555 of today's low, that $20 range. I mean, that would still be a decent bounce back to highs. But stay stuck in that range the entirety of the week. Let a bull flag build out, and then we'll be deciding which way the consolidation breaks next week. Definitely possible. So just remember that that's how markets can correct, but an extreme extension can become more extreme, but it tends to be that the rate of selling that we're looking at is not something that can last for a significant period of time. But it could last for longer than you expect. It certainly did during parts of that COVID sell-off. From Richard, do you have any thoughts on AEO? I'm considering an intraday short before the earnings report. Yeah, I mean, I don't like to an intraday short before the earnings report. I don't know. You know, the market's closed right now, so you got to see where we open tomorrow. Like that type of assessment, I prefer to do in the mornings because you can include how the stock is gapping into your analysis of whether or not you want to put that short on. Like you might be thinking about a cute intraday short tomorrow before the earnings report if it opens up at 12.19 tomorrow. But what if it opens at 13 quarter? What if it opens at 11 quarter for some reason? You know, your thought process is probably going to change based on how that gap occurs. So the first thing I would say is that's something you should assess in the morning and not in the afternoon. Second thing I would say is I don't really like putting new trades on right in front of an earnings report like that. Generally speaking, I find pure day trading to be reward limiting, even though there's been some phenomenal opportunities recently for day trading because the volatility and the movements have been so big. So why do I want to put on a trade that, let's say you nail it tomorrow, you short at 12.19 and it closes at 11.60 and you got a nice, nice profit cushion with good execution, but not like so much money with so much downside extension that you would really want to cover it because it looks like it could give you more. You want to keep that, but now you can't keep it because it's right in front of the earnings report. So, and also generally speaking, I don't think market participants like to make a whole lot of new bets right in front of a major event like an earnings report. So the price action becomes a little bit trickier. So usually I find that once I'm a few days away from a stock reporting earnings, I just don't want to trade that stock anymore until after the report occurs, and then I can reassess based on all the new information. Thanks for the question, Richard. From Tate, only reason I asked is because after today we have seen the biggest we've ever seen, at least in a few years. I'm guessing it needs to be a recurring thing to consider a change. Yeah. No problem, John. From Joshua, it's institutional margin calls that matter. 100% agree with that. When you get a call in the morning, you have till 2:30 usually to either send in funds or close the position. And I assume though, Josh, that if the position moves in your favor, does that also negate the call? I would assume it does, but again, I've never had a margin call, so I really don't know. Which is why we look at 2:30 p.m. for margin call pressure to end. I just don't know if it's T+1 or T+2 anymore for calls. So if they got one on Friday, it would still have to be. I think it's T+1. Delta Airlines having some news. Delta getting smoked. Delta Airlines CEO says consumer confidence is kind of coming down. You think? Corporate and consumer spending started to stall. Good. I need some cheap flights. and they lowered their Q1 guidance. Musk says that running other businesses with great difficulty. That's a quote, I'm assuming. Musk plans to stay at Doge for at least another year. Tesla is just like an electric car on fire. Oh man, this thing is so bad. Oh, 15%. Who would have thought? They'll say maybe sideways until the CPI or until the 314 debt funding. Yeah, and then we also have that potential government shutdown thing at the end of the week, which is huge. Mike has a chart that he's sharing here in the VTF of Amazon. Can't tell what time frame that is, but you can see that capitulation on that volume at that low. Thank you, Mike H. Elon Musk says, if Doge doesn't succeed, there won't be any money for anything. America will go bankrupt. When asked about the strain on his other companies, Elon said, it's very difficult. I'm just here trying to make the government more efficient. When we say acute trades, it's from TT, what defines acute? When we say acute trade, we just mean like a little day trade, probably like a shorter time frame trade where you are not, risking a tremendous amount of money. Your sizing is small. You see an opportunity where you think you can make a few bucks for yourself, but if it doesn't work out, it's not going to really matter to you too much one way or the other. But, we all like making an extra few bucks when and where we can. From Vikas, do you have any rules when you will or will not put an opening order in the morning outside of upcoming earnings? I don't think so. I mean, just generally, I think I'm just following my game plan. So my game plan says I'm supposed to buy or sell, then I buy or sell, and I do it pre-market, I do it at the open, I do it during the day, just whatever my game plan says. From Dave S. Forgive me if this is a question that is not appropriate, but is there anyone who is a public-facing financial figure who is still in favor of this tariff plan? I don't get the strategy. I mean, there's plenty of politicians that are pro-tariff. It seems to me like a lot of them are just being that way because Trump wants them to be. I don't see how someone like Scott Bessent could actually be for tariffs in the way that he has said. But let you do your own research on that. Let's keep it to the trades. Politician does not equal financial figure. Yeah, I mean, literally like every single person who is worth their salt in the finance universe that I've seen is against tariffs. From Richard, I forgot a question. When we talk about a rebound in the SPY or Qs, we are saying the TQQQ is moving in a similar movement. Yeah, TQQQ is the exact same thing as the QQQ, it's just levered. Just levered ETF. But they move hand in hand. I am asking because sometimes it seems difficult to expect exactly how much TQQQ moves aside QQQ. It's not, so it's a triple effect minus decay. So in reality, it means that any levered ETF will always underperform its actual ETF because the way the math works, it creates decay. So it is not as simple as it. Basically, what it means is if the QQQ moves up a percent, the TQQQ will move up 3% minus the decay from the volatility based on how percentage math works. If QQQ moves down 1%, then TQQQ is going to move down 3% plus the decay. So levered ETFs on like a percentage basis of the leverage, I guess, always underperform their counterpart. But they can be good for short-term trading. That's literally what they're made for. Like, as an investor, if you're an investor, you should never, in my opinion, put on a long-term investment in a levered ETF. If you go out long enough, you will show, like, even in a sector that moved up over the course of 5 years, your sector moved up 30%. There's a good chance that your levered ETF is up less than 30% because it took 5 years for that to happen. And again, you could do a little research on your own on how the math works on that. So you should never, in my opinion, own levered ETFs for investments. But for trades, they can be good. And for me personally, I like trading a $60 TQQQ versus trading a $474 QQQ. There's just so much more that I can do with the levered ETF by having more size and more complex game plans because I have more size, and I make money off of volatility, generally speaking, from a lot of my kind of cash flow trading strategies. So, the increase in the volatility from it being 3x levered is welcome for me, and I like it as a trading vehicle compared to the QQQ. Cool. From Tate, I heard you can hold 90 days with most levered ETFs until it really hurts you. Percentage return wise, I'm not sure if that's a question. Yeah, I don't know. I've never heard that as a general rule. It depends on the volatility of the underlying. The greater the volatility of the underlying, the more the levered ETF will decay. Which is why I like the concept of like these 3x levered. I'm about to go on a tangent. I really feel like if you are a retail investor, you should have to take at least some sort of quiz before you are allowed to either trade options or buy or sell a levered ETF. Because I think that most people have no idea what they're doing. Most people just assume it means like, oh, I'm going to buy the 3x MSTR and hold it for 10 years because I like Bitcoin and I want to have it long and it's going to make me even more money. And you couldn't be further from the truth. I don't think that they should have to take like a series examination. You shouldn't have to be Series 7 licensed to trade an options contract or to buy TQQQ. But like there should be a rule, I think, that retail brokerages should have to provide like a 30-minute education class and quiz that you have to pass. The point where, you're taking it from home, you could probably even cheat on it and look up all the answers on Google, but you're still looking up all the answers on Google, and then maybe that makes you go, oh, interesting. I didn't realize that levered ETFs decay. What does that mean? Like, I really think that should exist, but it doesn't, and it would hinder Robinhood's profits. So we don't want that to happen. Cool. Looks like I got through everything in the VTF for the moment. I haven't even logged into the YouTube yet. Let me check that out. VXX is not as extended as the market, so no blow off top yet. VXX is really starting to extend. Where's the actual VIX? Yeah, VIX got up to 29 today. VIX is starting to get up there. Just looking at it. We had this pattern back in the 2022 bear market, and I was just trying to remember what the numbers were. I think it was like sell VIX 35, buy VIX 20, and it lasted like that entire calendar year, more or less. And at this point in our high today, it looks like we just got up to 29.50 or so. So yeah, there could be some more room for this VIX to further feed on itself to the upside. From Apex Joy, during the last 10 plus days, the market has been up and down by some news like tariff or data release. Was today a specific news trigger for the sell-off? I didn't see anything new today. I didn't see anything. I didn't see a single, unless I missed something in the VTF today. I was very busy. I didn't see, it seemed like it was the first day in a long time where we didn't see a single Trump headline statement really go through the VTF the entirety of the day that would be market impacting. which is interesting. I think that today's sell-off, and this is just me speculating. Um, I think that today's sell-off came from a lot of market participants actually starting to wake up to the sell-off for the first time just over the course of the weekend. We had a you know I don't want to say a long weekend because that implies that it was more than 2 days, but there was a long 2 days there for market participants who are maybe in the retail world or maybe even in the fund world to all of a sudden maybe wake up to the fact that their portfolios were beginning to kind of implode and panic a little bit. And I just felt like I saw over the course of the weekend on my social media significantly more than any other time over the confines of this sell-off on economic growth slowdown, all the stuff that we've been talking about for weeks, um, that maybe woke people up to actually do some real further selling. But I would actually evidence that as us being as an additional piece of evidence that we're closer to a real short-term bottom than anything else. And you're starting to get those final sellers that came in. I mean, don't you remember? Does anyone remember in January and February where retail posted like their top five of the last top 10 like individual days of buying, like historically going back as far as the records go? Well, they're all out of the money on those. So no, I don't think that there was any specific news trigger for today's sell-off. From Steven, any thoughts on Musk saying he'll be doing Doge for another year? No, 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 no thoughts. I have no new thoughts on that. I do hope that if there is any corruption in the government, that he is able to rid it. But I am still of the exact same opinion on Tesla as I have been for a while now. I think that he's absolutely imploding this company, and he's destroyed his brand. So we'll see what happens. I would not be shorting Tesla as much as I'm a hater on it. I would not short 225.50 in Tesla right now. No way. But it's one of the number ones on my list for a short on any major bounce back if a setup comes in. Plasma Lab saying, so tariffs are fine for other countries but not for the USA. No, no. I mean, this is just basic economic theory. Tariffs are bad for any country that want to do them. So if other countries want to hurt themselves by implementing tariffs, then that's their problem. I would prefer if we didn't hurt ourselves by implementing tariffs as well. I mean, that's literally what's causing this market sell-off. So tariffs are bad economics. And again, it's like I said when I spoke with Greta today. I'm not a politician. I'm not in the business of talking about any other knockoff effects on tariffs except for their financial impacts. It's not my business. If you want to make arguments that are we need tariffs to stop the movement of fentanyl, or we need tariffs to I don't know, national security reasons. I am not an expert in those areas, and I am therefore not in a position to opine, and nor will I. But just from a basic economics perspective, it's really simple. If if Tate can make corn better and more efficiently than I can, and I can make widgets better and more efficiently than Tate can, then I should make widgets. Tate should make corn. I should trade my widgets for his corn, and everyone is going to be more better off because of it. And we'll be able to have more corn and more widgets at cheaper prices because we are utilizing our strategic advantage to be able to make those things. And it's one of the things that during the 2010 period where we had very low inflation for a long period of time, we had increasing globalization throughout that period of time, and it kept economic growth strong, and it kept inflation down. And that's just basic international economics. From Tate, most retail brokers, including Lightspeed with portfolio margin, either hike levered ETF margin requirements to 90% instead of 25% with non-levered ETFs and non-volatile stocks. Yep. Yeah, for sure. right. It looks like I got through everything in both the VTF and the YouTube. I hope everyone had an okay today. I know okay day today. I know I certainly got smoked, which sucks, but it's part of the business. You will have your down days. I definitely started too early today. Uh, let's see what happens tomorrow. Let's see how we gap. But generally speaking, the degree of selling we saw today, I do think that we're starting to line up for a real bigger bounce here, and then we can assess when it comes if it looks like that bounce should turn into something more, or if that's a pivot high that we should be looking to short. Have a great night, everybody. I'll see you all tomorrow.